All right. Well, hello, everybody, and welcome to today's presentation, Specialty Disability Insurance for Physicians, brought to you by IDU and Risk. Welcome, everyone. I am your host, Seth Groff, and I am joined today by DI extraordinaire, Ryan Lobo. Ryan, welcome.
Thanks, Seth. You're gonna make my cheeks all red.
What's happening in Nyack?
Not a lot. Finally getting some spring weather. Excited to be talking about physician DI here and ready to get into it.
All right. Well, in addition to, I was interested in the local happenings in Nyack, but my other favorite topic is disability insurance for physicians. And, I spend a lot of time Googling and leaving voice messages for people that work with physicians, specifically in the DI market. And the reason for that is that physicians make up one of the largest segments of the disability insurance market, and obviously they have a need for the solutions that we provide at both IDU and Risk. And I believe that if you rely on your income, you need disability insurance. But the physician market is interesting because it's one of the only industries where they are told while they are in school by both their educators and then also financial professionals that they need disability insurance. And why? Because they spend a lot of time and money mastering their craft. They also see illnesses and accidents on a daily basis. And once they start working, they have the income to buy disability insurance. And they buy it. They see the need for it and they buy it. And so it's a huge market. And I really like to talk about how Risk and IDU can complement what you're already doing in this market. And if you're wondering, well, Seth, how big is the actual physician market? This is a Milliman survey. It comes out every year. There's two charts in this survey that I like to go look at. The first chart, I always like to go look at the percentage of declines by, the traditional DI carriers. The second one is I like to look at the distribution among occupations. And you can see that in 2024, that's the most recent year that this survey has, but 33% of the premiums sold for disability insurance was to doctors and surgeons. And if you throw dentists in there, now you're up over 40%. And this includes both individually underwritten and GSI premium, but it does not include like the base group. But if you look at individually and GSI business from the traditional domestic carriers, it's a third of every dollar spent on DI premium is in that market. And just before this call, I went out to good old Chat GBT and I put in there, what percentage or what percentage of the US workforce do physicians make up? And it's roughly 6.6 to 0.7%. So not even 1% of the working population are physicians. That was based on roughly, 1 million to 1.1 million physicians and assuming 160 to 170 million individuals in the workforce, but less than 1% make up physicians, yet it's a third of the DI business. So, two conclusions from that: shame on disability professionals. We need to sell more to these other segments of the market. But at the same time, it's a market that I want to participate in because at the end of the day, this is who is purchasing DI insurance. Now, if you work in the physician market and if you have conversations with insurance professionals, kind of the hot topic is always GSI insurance and what these traditional or domestic carriers are offering. And I'm telling you, they offer some great products. Okay. With that being said, they don't cover all the physicians. So we'll kind of talk about where we fit in, or we can even sit on top of that in some scenarios. But I am going to say this: if you look at a lot of this premium that's being sold GSI in the resident market, right? The people that have the ins into those programs they're pretty rooted in those programs. I'm just being transparent. And so if you want to get into this market, if you want a wedge into this market, I think that a lot of the concepts we're going to talk about today and what we consider specialty DI is a great way to wedge into those markets because a lot of these agents aren't talking about the concepts that I'm going to talk about today. And, I'm going to be candid, it's a small percentage of the overall market, but there's still a tremendous opportunity, an opportunity to get in there and work with those clients and also, protect their incomes and make a little bit of money. So I want to take a look at just from a high level overview what we're talking about when we say specialty disability market, disability insurance market. Now, remember, we are Risk and IDU. We're both part of the same company. We just operate under two different brands. Risk is going to be our flagship impaired risk product, typically sold to individuals that were declined with a traditional carrier due to a pre-existing medical condition. And then IDU is our Lloyd's cover holder. We also do impaired on the Lloyd side, but we see a lot of opportunity for excess coverage, especially with physicians, and then also business solutions. So if that physician owns their practice, right? They might have a need for key person insurance. They might have a need for a buy sell DI policy, or they might have a need for BOE and some other products. So really that's what we're going to talk about and kind of the three areas where risk and IDU can help you. Number one, declines due to pre-existing health conditions. Number two, excess coverage. And number three, business solutions. So let's jump in and start right away with the declines due to pre-existing health conditions. So,
Yeah, and really quick, Seth, right here to
yeah,
jump in. I think you just brought up a really big highlight point on what makes IDU and Risk so different from a lot of your other specialty Lloyd's cover holders or shops where you'd be going outside of your more traditional options, where you have one team of underwriters, case managers, salespeople who are working on both sides of this business on the Flex IDI as well as the Lloyd's IDI and business products. So while they might take two applications, really you're looking at one set of medicals, one set of financials, one team that you're interfacing with and doing policy services with, when you might actually be selling that client multiple different policies, different DI solutions there. So it does make
yep.
us incredibly fleet of foot and very unique in this space.
Yeah, I like to tell people we'll shoot you straight too, meaning that we have both sides and we'll tell you what side is the best, where there's not another organization out there that has access to the product suite that we do. So, they're always going to point you in the direction of what they have, where we'll be like, no, you should use risk for this situation, IDU for this situation. I might get that on a t-shirt. Ryan Lobo, DI extraordinaire, and we'll shoot you straight. I don't know if anybody buy it. I'd wear that though. But let's talk about impaired risk DI. Now, these are individuals that are declined with the traditional carrier due to a pre-existing health condition. And I always tell people they have three options. Option number one is to go without insurance. And, in some situations, I know people that sell DI, they don't like to hear the concept of going without insurance. But if their health is really severe, they have unstable work history, maybe they're, getting towards the end of their working years. And, when you start looking at the premium, it just might not make sense. There are scenarios where, just going without insurance might make the most sense. I always like, don't recommend, just walking away, show them their options, but it happens. Sometimes people decide that insurance isn't the best way to protect their most valuable asset, their ability to earn the income. So I'm going to assume here, though, I don't have to sell the people on this call on the disadvantages of going without insurance. So I want to talk about the other two options, which is either going with the Lloyd's option or a graded benefit option. Those are kind of the two insurance options that they have if they can't get coverage with the traditional DI carriers. And I'm very passionate about this. I've kind of made it my sole mission to get out and sing from the mountaintops that in a lot of the scenarios, I'm very firm that if they have a pre existing health condition, Flex DI or Risk's product, their graded product, is a lot of times a better solution. And I would take a long, hard look at it before going with the Lloyd's option. And I'll kind of walk through why I believe that. And look, we do both. We write it on IDU and we write it on Risk. But if I'm looking at the client and I want to protect their income with a quality product when they can't get it with a traditional carrier, Risk is a lot of times the way to go in a lot of the scenarios. So I got an example here. 40-year-old psychiatrist making 200,000. Unfortunately, had a heart attack and was, declined with traditional carriers. So just for comparisons purposes, I did $10,000 a month, 90-day elimination period, and the pricing on this at the bottom is actually 5-year BP on both. We'll actually go all the way up to a 10-year BP on the Flex product, which is the longest in the impaired market. But for price comparisons, I just did the 5-year benefit to, make it as close to apples as I can. So that's one advantage of Risk right there, is that we do have that 10-year BP available and the ability to extend the own OC definition out to that full 10 years, which is huge. But some of the other key benefits to it is that with the Flex DI, it's guaranteed to renewable to age 67, where with the Lloyd's product is renewed every 1 to 5 years. The advantage of a guaranteed renewable product for your client is they only have to go through underwriting once. And so keep in mind that this is someone that has a health condition. And so only being underwritten once means, one, you only have to go through the hassle of it one time. But it also means that it's only one time that they can, add exclusions if they're going to add it. It's the only time that, they're going to require, any type of documentation. And so it's good to get the underwriting done so that if their health changes, it's not going to be re-underwritten, because the reality is that every time that Lloyd's policy goes through underwriting, it could come back with additional exclusions, warranties. It just depends. And so let's get it underwritten once, get the policy enforced, so the client knows what to expect. So that's a huge advantage. The other huge advantage, and especially on this particular one, is if you jump down almost to the bottom where it says underwriting decision. With the Risk product, we have a little bit more flexibility to get those out the door without an exclusion. And this was a mild example of a heart attack. And so back to work, everything's looking good. And we were actually able to get this issued without an exclusion on the cardiovascular system. So think about this. They were declined, said, hey, you can't have DI because of this condition. And then we were able to actually issue it without an exclusion with Risk. And so that's a huge advantage as well. Another one that I will point out is the level premiums. If you're not familiar with what guaranteed renewable means, it means that the company can only increase the premiums if they refile the product. We've been doing this since, I think, the 80s. We haven't had a refile. So usually the premiums are going to be level for the course of the policy, where with the Lloyd's product, your price is going to increase every 5 years. How much? I don't know. We'll tell you at the time of renewal how much money we need from you. And so, that's the other nice thing about the Flex product, is that them premiums are going to be level. So those are kind of the key points that I like to point out. There's also, mental nervous. We do have mental nervous with Flex, where that's typically excluded with Lloyd's. Benefit resets. So if you're back to work for 6 full months, then that you're eligible for the full benefit again. And so there's a lot of advantages of the Risk, but really, I would say underwritten once, ability to cover the condition potentially, level premiums. Those are kind of the 3 big ones that I think provide the value that justify the cost. So you can see that's the thing, right? That's the hiccup, is that the Flex DI is coming in at 375 a month, where the IDU is 217. So it is more expensive. With that being said, with a premium of 4,123 and an income of 200,000, we're just slightly over 2% of that individual's income, which is kind of the sweet spot for premiums for DI. So, I always like to show people that. I think that one of the biggest mistakes I see in this marketplace is that the agent shows the Flex versus the Lloyd's, and they don't do a good job of explaining it. If you actually show the Flex versus what they were originally sold with the domestic, it's a lot easier to anchor. And I want to show you the premiums there. So I just reached out to one of our partners, and I said, hey, if you had a 40-year-old psychiatrist making 200,000, what would you recommend to them for a domestic product, right? So if they were healthy, what would you put in front of them if they were healthy? And this is a age 65 non-cam policy, very strong, very prominent DI carrier in the physician market or medical market. But the premium on that was 4,243. Now, I know we're kind of comparing apples to oranges, but we're also comparing a healthy person to an unhealthy person in terms of medical conditions. But you can see here that our premiums are like right in line with what they were originally sold. Now, I know ours is a 5-year BP. It's guaranteed renewable. It's not the same product that was originally sold, but it is going to be the best solution that they can get with their current health condition. And so I always throw this out here because everybody says that Flex DI is expensive, but you're always comparing it to an IDU term policy that has to be renewed every 5 years, right? So I like to throw this up there because you can't say it's too expensive. You can say that maybe it doesn't have the value for the premium. I'll argue with you about that, but you're going to sell them a $4,200 premium to begin with. So don't tell me that it's too expensive there. And then the other idea that I think is undersold a lot in this market is that if premium is an issue, let's do a blend. As Ryan mentioned earlier, we underwrite both of them. You do have to fill out 2 applications, but let's do 5,000 on the graded product, 5,000 on the Lloyd's product. That way, if that one portion you're not eligible for because of health, you're not completely left without disability insurance. And now I'm down to $3,500 of premium as well. And so I think that is a concept that I want to promote more, is kind of that blend. Like it doesn't have to be it doesn't have to be Lloyd's or graded. It could be Lloyd's and we're the only company that can provide both with one streamlined underwriting process. So, anyways, like to throw that out there because really the price objection, and I will admit that I cherry picked our example because I know our pricing on it is great. In a mild condition, there's always caveats, but this whole too expensive, it comes up a lot, but I just ain't buying it. So, anyways, there's the impaired market. With the product, I kind of hit on the key points. The only thing, remember that the product is graded. And so what that means that if you're disabled due to a sickness in year 1 from days 0 through 365, you would only receive 40% of the benefit. So in that 10,000 example, it would only be $4,000 a month. In year 2, if you're disabled, it's 75%. And then, starting year 3, it's 100% for illness. Accidents covered, immediately. The other thing I will point out is that our maximum benefit is up to 25,000 of coverage. We do not have financial restrictions there, meaning that, if somebody maxes out their domestic coverage, it meets the participation limits with other carriers, we'll actually stack the full 25,000 on top of it. So we don't participate in participation levels, so to speak. The other thing is that some incomes like chiropractors are capped with a lot of the other traditional carriers where we'll issue up to the full $25,000 a month, assuming that their income justifies it. So less financial restrictions with the Flex than a lot of the other traditional carriers.
And on the point of that the
Yeah.
chiropractor, I actually do see a lot of agents coming to us where They might have had a non-can or a more traditional option for a chiropractor, for example, but the pricing is really comparable, and that chiropractor is able to get up to 25,000 with one
Yeah.
single policy, meeting their full needs. And instead of making that client go through two underwriting processes, two applications, they're starting from $1 with that Flex DI. So it fits really nicely with some of those less favorable medical occupations as deemed from other traditional carriers. You might have, a naturopath, an acupuncturist, so on and so forth, where it's just not even a great fit to have them go through all the legwork of multiple policies where they can get all of their needs met from $1 with the Flex.
Yep, yep, definitely. And also, we don't automatically throw on back exclusions for chiropractors either, right? We're only adding that if they have back issues where I'm not 100% sure, but I've heard some of the traditional carriers, if you're chiropractor, you automatically get a back exclusion. So, something else to keep in mind, we're only putting the back exclusion if you have a history of back issues on those chiropractors. So, definitely a great market for our product as well. One more case study for you. What I want to point out here is the 7-year benefit period and 180-day elimination period. Um, like if you look at what's sold in the DI market, it's 90-day elimination period. So that's what everybody quotes and requests. If you are end up in, well, you should be doing this with all your clients, in my opinion. But if you end up in kind of this impaired market, one of the things you need to be looking at is what they have in savings, right? If they only have 3 months in savings, write them the 90-day elimination period. But if they have done their, proper planning and have 6 months of savings, and that's accessible, write the 180-day elimination period. We bumped this up with the 7-year. So going with the, waiting 90 more days before 90 more days before you receive the benefit, like gets you 2 additional years of benefit payments for about the same premium. And so just something to look at. We do this a lot. We see a lot of times, the 100-day elimination period, 7-year benefit period, give them a couple extra years on that BP. Obviously, this one, they had group coverage. And so we stacked on top of that. Which is great for especially for in this physician market because a lot of times the group policies are capped out at 10,000, and so these higher income physicians need more DI, and so this is a great example of that. And then just one more example: family practice physician again had the uh, group coverage, and we stacked on top of that. Went with the 10-year BP. This one does have, the own OC rider extended to 10 years, so you can see what that costs as well. But two common examples of where we come in and protect clients, with pre-existing health conditions. So to recap, we do both IDU and Flex DI for this market or risk, but I'd take a hard look at the Flex DI product because, in my opinion, it's just a better solution. So, Ryan, I know I've been talking most of the time. I want to jump over to IDU and the Lloyd's market. Candidly, there's been a lot, which I'm sure you're going to go into. There's kind of been some turmoil in physicians in the Lloyd's market. So you've seen some cover holders imply some restrictions. Our leadership is actually over in London, right now. So everything's looking good with our block of business. But why don't you kind of share with us, what you're seeing in the Lloyd's market and also how IDU can help when there are shortfalls in the traditional DI market.
Yeah, absolutely. So I've been working in the Lloyd's space specialty market for, gosh, almost over 10 years now. So I have seen a lot of changes and shifts. I think this is, I'm a, a Lloyd's fanatic. It's really my core background. That's where I land, and I'm a huge proponent of the Lloyd's products. But going back to Seth's earlier point, I will say 100% 10 toes down when you're talking about personal income coverage for physicians, particularly those with pre-existing medical conditions. The Flex DI product is just across the board one of the best solutions there, especially when you're dealing with these younger professionals, right?
Yeah.
Individuals with diabetes is a big one we talk about because we don't exclude for diabetes. They have, I see this all the time, mental nervous conditions, individuals coming out of their residency and their fellowship, and they've had a medication change or they've done some self-prescription, where the issue isn't actually egregious and it's well maintained. It's just not looked at favorably by your traditional carriers. That Flex product, having the partial benefits, the mental nervous built in, the ability to do a full own occupation, and then not being re-underwritten is incredibly powerful for those young professionals who have many, many decades of working years left in their career. Where on the Lloyd side, again, there is going to be shifts and changes in the market space. We're going to talk about older age physicians a little bit here. There has been some tightening up. So you can't always predict what that next 5 years is going to look at from a rate standpoint, from an underwriting philosophy standpoint. And so locking in that flex on the IDI side gives the client that stability, gives them the lowest rate possible, and allows them to oftentimes get those coverages without any kind of exclusions or modifications. Another big thing that also gets lost in the comparison is that Lloyd's benefit periods, they do not reset. So if a client goes on claim for a year and they have a total of a 5-year benefit period, if they go back on claim, they now only have 4 years remaining, where on the Flex DI side, that benefit period is going to reset. So it's a lot richer and more substantial from a income protection standpoint, especially again for those younger professionals. Now, of course, when you're dealing with clients who get to the 50, 55, and they maybe only have 1 or 2 renewal sort of cycles before they'd be ready to kind of retire, that's where I see the Lloyds fitting better than the Flex. But broadly speaking, across the board, I just wanted to share that thought process because I do so often focus on the Lloyd's side, and I'm a huge, huge proponent of the Lloyd's products here. So for the personal income side, we're gonna, we do also do the impairments. Many times you're going to see exclusions on the Lloyd's because this isn't a graded benefit product. And it is full own occupation. So we oftentimes will be applying exclusions there. And a note on the exclusions and restrictions. I often have this conversation with agents and GAs, that it's really important to ask us, hey, this exclusion, how firm are we? Can we narrow it down? Can we buy it out? And I've seen it time and time again where in the preliminary quoting phase, we're working with a very limited amount of information. So we're giving, kind of a general terms together. But as we move through that process, oftentimes I see where instead of an exclusion, we're able to extend the elimination period specific to that medical condition, right? So they might be purchasing 90 days, but for cancer history, they have to wait 180 days because it's been more recent. So instead of having an exclusion, they just have to wait longer, which still gives them the coverage if something really serious happens, but also allows underwriters to mitigate that risk. So we get very creative on our exclusions, on our restrictions, on our plan designs, and try to hone in on what works best for the client. Maybe they're on a tighter budget, or maybe they have more money to spend and they'd rather spend more to remove some restrictions and make the coverage richer for them. So we see, a whole different spectrum of client needs and are here to help answer that and navigate you through what works best for that specific individual. In regards to the personal income, so we see this on the excess side all the time. A lot of doctors are making, hundreds, if not millions hundreds of thousands, if not millions of dollars, and their needs just aren't being met where they're falling at a 30% replacement ratio. And really they should ideally be, a 60 to 65 at least. So we do the excess portion here on the personal income side very often. And one big highlight I want to point out is that we do offer 10-year benefit periods for physicians. Those are for physicians that are under age 50, and we're talking about the healthy individuals, the non-impaired. So when we're dealing with an impaired, there is going to be more restrictions, there's going to be some exclusions, some ratings, but it is still a very good solution for those clients. When it comes to your healthy physicians, like we said, the 10-year benefit period, we do most commonly a monthly benefit. Usually it's a 90 or 180-day wait. But we also have a very interesting benefit structure, which is the lump sum benefit. And that's going to be the permanent total disability. So the threshold is that the client is not expected to recover and return like they would be if they're collecting monthly benefits. So monthly benefits you can think of as your more immediate, day-to-day, month-to-month living expenses. And that lump sum is kind of more marketable as a debt consolidation. Maybe they've had a lot of medical expenses, or because they're no longer able to work as a surgeon, now they need to go back to school to go into a different specialty that they can do. And so it can be used as sort of a seed money, debt consolidation, all of those kind of things where you have a big balloon payment. And I really like this in the combo structure of answering those immediate, oh my God, how do I pay my mortgage? How do I, pay my grocery bill? And then, as they're dealing with that and trying to recover from that disability, it's found that they're just not going to be able to perform their own occupation, and they're going to need to pivot. Now they have that balloon payment on the back end to help cushion that transition. So it does make a really powerful solution that you only see in the Lloyd's space. So I think it's a very interesting plan design, particularly for your healthy and high income earning clients. One little thing I want to touch on is the no medical exams. This goes for both FSL and our Lloyd's products. We do all of our underwriting on APS records, so the client doesn't have to go schedule a paramed, do blood, urine, anything like that, making it a lot easier for the client. Most of our intention here is to make the sales process and the underwriting process as easy on our agents and our clients as possible. So we have a couple of different programs in light of that. We can go on to that next slide.
So just
Oh yeah.
one quick question. Clarify this. I
hmm
could potentially have a policy that would pay 50 million
hmm
and I can get that with no medical exams?
Absolutely. Well, yeah, okay, the 50 million, you might got me there.
Well,
There
all
will be
right,
some
25 million.
additional,
I don't care.
yeah,
Like that just
absolutely.
blows my mind. Like when I when I
Yeah.
came when I came when I came to the Lloyd side, I'm like, we'll do how much
Yep.
with no
Yep.
medical exams? Like it is amazing of how fast some of these policies get issued. Sorry.
Mhm.
Bad question there. But I don't I mean it's truly
No,
is
it's true.
amazing
It's true.
the policies that we
Once you
issue
get
without
over
medical.
the 30 million, you might start to see some more, extra things to jump through, but that's due to the benefit
Yeah.
size. But yeah, I mean, you're talking 25, 30 million, we're doing APS records, no medical exams there. So, that is definitely a big, big touch point. So for the medical residents, this is, we know that there's a ton of these GSI and these hospital sponsored programs for their medical residents and fellows. But there are still gaps in those programs. Specifically, students, residents who are from foreign countries who have come here to do their medical training. They might not qualify for those domestic programs, or individuals where that GSI sort of program isn't readily available and they've had to go out as an individual to find a solution, and they have some medical conditions or they have those mental nervous stuff where they're doing overnights and their sleep is all wonky, and they're not able to get into that medical resident program. We have this on the Lloyd side designed specific for those individuals whose needs aren't met. The philosophy here is obviously when you're in residency, you're earning about 60 to 75,000, and then very quickly they're jumping up to 250 plus of income. So this is basically sort of a gap policy to get them, robust coverage because they do have more earning potential in the very near future, and then have it renew for an excess policy, right? Where we are doing 7,500 with some lower limits based on their specialties. And that's going to be up to 100% of their income. And then they're able to then flip into a renewal process, get a streamlined excess Lloyd's option where maybe they did have some GLTD kick in with that new employer, that new contract that now they're out of their residency program. So this is offered in all the states we write Lloyd's except for New York. We do up to a 5-year benefit period there. Policy terms are typically up to 3 years. And as long as they're in their last 2 years of their fellowship or their residency program, and they're under age 40, we're able to offer this option for them. And essentially, it's waiving all of the financial underwriting and justification there. All right. And another underwriting program we've designed. So again, going into that theme of, trying to find areas where, the traditional carriers are falling short, where we fill in, and making this as easy to sell and as easy to obtain as possible. So this top-up program is for your clients who have gotten approved and issued a standard domestic IDI policy. We are piggybacking essentially on the underwriting because they're more restrictive than we are. If they've okayed the risk, we are very comfortable piggybacking without doing any kind of medical underwriting, essentially using a short form application with some sort of catastrophic medical questions, a copy of that domestic policy to have the proof, and then just like a prior year tax return or pay stub to see that they financially qualify for the benefit. And we can go up to 25,000 with this program. It's up to that 5-year policy term. And again, you are doing a short form app, a quick little pay stub, no medical underwriting. So essentially, we are able to get these policies issued in just a couple of days of receiving that application, making it so easy to get that excess portion for your clients when you're already going through the process. You're already having the conversation about needing IDI. So it makes sense when you're having these conversations with these clients. And you might be going to a principal or a Mass Mutual, and in tangent you can come to us and say, hey, we're applying for 20,000 here, they qualify for another 15,000, and get that quote out in front of them, get that conversation ball rolling, get those applications in, because it just makes it so much easier right then and there when that point of sale is happening. So this top-up program is intended to make that process, again, even easier for you.
Yeah, I mean, from a sales standpoint, the people that are really good at this, they're talking about the excess
Mm-hmm.
when they're talking about the IDI, right? And so they're already having that conversation. They're showing them the need, and then it's kind of then they're kind of putting a time restraint on it, saying once that domestic policy or that traditional their IDI is enforced, it's like, hey, the clock's ticking. Let's do that excess now. Let's not wait because it's going to be a streamlined process.
Mm-hmm.
So there's agents that are like, I just want the IDI. I don't want to talk about the excess. I'll talk about the excess next renewal, or not next renewal, but next review. Okay, but you're missing the window for this streamlined program. So talk about it the entire time, and you'll have a lot more success.
Yeah. And and for sake of time, I'm not going to spend a lot of time on the case study. This is obviously the excess IDI, with Lloyd's layering on top of that group and IDI there, and offering up to 2.4 million additional aggregate benefits for that individual who's making a lot of money and who's a plastic surgeon. They've worked very hard to get there, and they should have that income protected. So we'll go ahead and move on into the business solution products. And before I get too deep down the key person rabbit hole here, because it is one of my favorite products to talk about, if you've been on a webinar where I've talked about this before, I'm sure you've heard me say that. So one of the interesting things about the Lloyd's market is that it's a Lloyd's marketplace. It is made up of underwriters and essentially syndicates who are taking on the risk. And we are, selling, underwriting, issuing the policies, collecting premium, all on their behalf. So we're writing with their pen and they're backing up these products. So they are, quote unquote, these surplus lines. With that said, as market trends shift and change, certain underwriting requirements and guidelines also can shift and change with that. One of these segments, being the physician market as a whole, if you have any experience in the Lloyd's marketplace, you've probably seen a dial back or even a total removal of writing the physician market from some of our other competitors in the Lloyd's space, where they're not even issuing any coverage to physicians because they've had bad underwriting philosophies. They have, essentially thrown the baby out with the bathwater in that they didn't astutely and, correctly underwrite some of these policies. And now, because of their claims history, they just don't have the authority granted to them by Lloyd's. This is not necessarily a market-wide decision. This can be specific to cover holders. So just because one Lloyd's outlet you might work with has told you no on a physician doesn't mean you're going to get the same answer from us. I will say, generally speaking, those older age physicians, there has been a lot more restrictions. We learned that selling $10 million of personal income in a lump sum to a surgeon with own occupation definition didn't always go according to plan. If something happens to their hand, they're permanently out and they're at retirement age. So some of those rich benefit offerings for your 60 to 65 plus physicians have definitely been dialed back. Now, with that being said, I literally just quoted a 66-year-old physician for Key Person yesterday. I was working on another physician who's 62 for excess IDI, just earlier this morning. So we very much are in this space. We are very much able to offer it. It just has shifted and dialed back from what it was, 5, 8, 10 years ago, so to speak. So again, another thought process of comparing Lloyd's to that flex is you don't have to deal with any kind of market shifts when it comes to renewals. And on the topic of renewals, this is another thing I see all the time is, a policy is up for renewal with another cover holder, and because of, their claims experience, that price is jumping up 30+%. They've dialed back on the benefit or they've, added new restrictions. And now it's incredibly difficult to go back to that client that had X and try to sell them Z, which is more expensive and less robust than what they were paying for originally. And of course, if you're in the DI space at all, it is difficult to get clients to write that check, especially for the specialty and the excess pieces of the DI coverage. And so when you're dealing with a renewal where those terms are, the pricing is shooting up, it can be even more difficult on that sales process. So I oftentimes see people bringing us, hey, we had these renewal terms come up. We want to shop this and see if you can do better. And across the board, basically, I'm seeing us being able to offer better rates, better limits, better terms. And we do have some underwriting allowances when an individual is switching from cover holder to cover holder. And so certainly if you have a renewal and you are having some challenges with it, or you just want to explore what other options are out there, bring those over to us because we'll be happy to do some analysis for you and happy to show you what we can present, whether that be for any of these product options here. So with that being said, quick key person highlight. Going back to those limits, we have some of the richest limits for any product, but particularly for key person and particularly in the medical space where we go up to 10 times income. So, you have a doctor making 100,000, that's up to $1 million of coverage. And oftentimes we're designing these as lump sums. And typically with the lump sum, because it is a career-ending disability, we don't go less than 12 months on the elimination period. It's just incredibly difficult for a client to satisfactorily prove in 6 months that they're not going to be able to recover and return to work unless you're talking about sort of a presumptive disability that it's so severe it's inarguable. But the pricing on those is pretty ridiculous. I would prefer designing a monthly benefit that pays out after 90 or 180 days, particularly for those business owners who are really the revenue generators and the ones who are the success of the business. They might have more immediate financial needs if they go out. So you can lock in a monthly benefit that deals with that. And then as they're figuring out if they're going to be able to return or not, they can receive those benefits and have the lump sum on the back end that then helps the business deal with, new hires, lawyer fees, yada, yada, yada. And the thing that I love the most about key person coverage is the flexibility. So these benefits can be used however the business sees fit, whether that's, new hire expenses, recovery of productivity losses, or like I said, a more immediate sort of business overhead expense. And so I do see some blending of the other products that can be covered with the key person. Of course, a certain solution, whether it be loan or buy, sell, or have you, might fit better for that client need, but the key person is so flexible. One last thing I want to talk about here is not only do we do, individual fully underwritten options, we also offer GSI coverage to physicians. And yes, your ears aren't broken. We not only are covering physicians in a broad spectrum, we are also writing these on a GSI basis. Of course, the scope is more restrictive. We do require that they have typically at least 5 to 10 lives, depending on the specialty and the group makeup. We also require that these are mandatory coverages, so it's 100% of the defined group is getting the coverage. Can't be cherry picking. It has to be, all of the owners of the business, right? Or all of the key persons at a medical practice. And when we have that, we can do the GSI, which is census enrollment and employer paid application. So talk about making it easy to put these coverages into effect and maximizing your commission, maximizing your clients' premium dollars. Doctors notoriously very difficult to get them to hold still, pay attention. Now you're talking about covering, 10 business owners or 10 key persons in a hospital without them even having to touch a piece of paper. And getting that coverage locked in with a GSI solution. It just makes it so much easier for clients to say yes. It makes it so much easier to put these plans into effect. And I'm a huge proponent of the smaller life business solution GSI options. And a lot of times for the business products, we're starting that from $1. So it's not that they have to have, key person, underlying DI, and then we're layering on top. A lot of times that business solution isn't going to be available in that kind of sense of how we can package this product up. So they don't have to have that underlying component. Now, on the IDI side, we do want them to maximize whether that's GLTD or some IDI, and then we can layer that personal income on top with a GSI solution for those high income earners. But for the business solutions, a lot of times that's actually not the case, which is a question I get on a very regular basis. Okay. And then again, this is one of those monthly followed by the lump sum plan designs I highlighted. Again, this being, a big revenue driver and the immediate loss being very much felt by the business. Having that monthly benefit solution locked in to help answer those is super meaningful. And then having that stopgap on the back end. So, and we'll jump right into buy sell here for you all. So buy sell, again, this is another product where we can do that GSI solution. We see this a lot of times coming into play for one-way buyouts, certain percentages of ownership that aren't going to be considered, and a lot of times family practice, family-owned practices and businesses where because they're family members, they just don't even be considered by a domestic traditional carrier here. So again, we design these to fit the buy-sell need, whether that be lump sum, monthly, or a combination therein. And another area that I always like to harp on is that you so often, especially for key person and buy sell, see life solutions being sold and the DI being neglected, whether that's because agents think there's not an option or that the option isn't going to actually, suit or satisfy the need, and they don't want to bog down the process or they don't want to make it difficult. What they really need to be thinking is it's not going to be difficult. There are easy solutions out there with IDU and those Lloyd's solutions for the DI portion of your buy, sell, and your key person. And it's just really important to not leave that off the table because statistically speaking, it is more likely that an onset of DI is going to happen in their working years than a death. So again, some consideration for business owners, and there's a lot of cross-selling opportunities when you're talking about excess IDI, buy, sell, key person, because a lot of these professionals, if they're not the key person, they might be the business owner, so on and so forth, where I'm talking about their excess IDI, but hey, have you thought about protecting that other chiropractor in your business who isn't an owner, but what would you do if they go out? And so that actually brings us into our case study here on the next slide. So this was a one-way buyout situation, excuse me, where they had an agreement with the other chiropractor who isn't an owner that if they were to become disabled, they would buy them out. So we're going to be satisfying that buy sell need and covering that 100% owner, but there's a huge cross-selling opportunity here for them to also lock in key person coverage on that chiropractor that would be buying them out. Because if, heaven forbid, something happened to them, and then something happened to the business owner, now they don't have any individual to buy that practice, and now they're going to have to go through any kind of debt, sales, looking for a new solution, and they're just in a whole lot of hot water there. So big cross-selling opportunity across the board with these products. And then
Hey
last,
Ryan, if you were going to market to chiropractors, would a good tagline in the email be "Don't have cracks in your DI"?
yes, okay, marketing light
Hey, not
bulb.
not only do I talk about specialty DI, but I'm a part-time comedian. No,
I
I
see that. All right, well, just to wrap it up, because I know we're pushing up here against time, is the additional business products that shouldn't be neglected here. So we have our loan indemnification and our business overhead expense. I would say the number one purchaser of these products are going to be your physicians. Because on a loan side, a lot of time these banks are requiring that coverage. And if they can't get a loan solution from a DI space, they'd have to essentially collaterally assign their own IDI benefits. And now they're disabled. They might be paying their loan, but they can't, pay to eat. So it's important to find a business solution for that loan that doesn't leave that client high and dry on their own income side. And then on the BOE, of course, this is going to cover your monthly business expenses, rent, the lights, making sure that practice can stay open while that individual is out and not being able to drive revenue and pay those bills. We have these products split out. I think this is a big differentiator from a lot of the traditional markets where their BOE products will include loan coverage. Our BOE product does not include loan coverage. That is the separate product. So the loan indemnification is specific for loans. Business overhead is specific for, that rent, that overhead expense outside of loans. And for the loans, we can go up to a 10-year benefit period. We craft the benefit structures to try to mirror the payment of the loan as closely as possible. And then again, you see a lot of situations here where that individual, needs the loan. The bank is requiring the coverage, but there is no solution out there because of their medical history or because of their age. So a lot of times we're seeing this from $1 on the loan side as well, and that's a big, big purchase block for physician market clientele.
All right. Well, thanks, Ryan, for all that information on the IDU market. I'm just going to kind of summarize and we'll let you guys go here. But, the first takeaway I want to make sure you have is if you look at people that work in the physician market and are writing DI on healthy physicians, the message they have for them individuals are, hey, get the best policy you can when you're young and healthy, right? That's what they're telling them. Get the best policy now when you're young and healthy. That doesn't change if they're unhealthy. When they're young and working and starting their practice, get the best DI policy possible. And even if they have health conditions, in my opinion, that's the Flex DI product. So that's first number one. Number two, in the business market, why IDU? We are, there have been restrictions in the overall Lloyd's market. We're still very strong in this market.
Mhm.
Also, we have those GSI solutions available. And you also have access to experts like Brian that is going to help you navigate that client situation and say, hey, maybe key person makes sense here, BOE here, loan indemnification here. And so we take that consultative approach to help you do that. And then finally, just remember, if you come across any DI policies and you're like, well, I can't figure out a place to take this, check with us. We'll let you know whether, yeah, there is an outlet for here, or no, you might, there aren't any solutions, or hey, we can't do that, but we can do this. And so never walk away from a DI sale. Always check with Risk IDU to see what we can offer. So with that, 11:55. So we're going to wrap up for today. Thank you, everyone, for participating. If you have any questions or have any clients that you would like quoted, you can shoot us an email at quotes@iduinc.com. My personal cell phone and also email address is up on the screen as well. So thanks, everyone, for joining today's call, and hopefully we talk to you all soon.
Thanks, everyone. Have a good one.